Welcome to Plead the Facts, presented by KI Legal. On today's episode, KI Legal co-founder Michael Iakovou, partner Socrates Xanthopoulos, and Senior Associate Matthew Zwiren are joined by Tony Zachariadis, principal at TZM Realty, to discuss current real estate market trends and future projections. Hi everyone, this is Mike from KI Legal, and welcome back to Plead the Facts. We're joined here, as said before, with Tony Zachariadis, my partner Socrates Xanthopoulos, and our Senior Associate Matthew Zwiren. We have an exciting lineup of things to discuss today. Tony, thank you so much for coming in. Tony, why don't you tell the audience a little bit about what you do, your core competencies, and just what it's like to be a property manager in New York City on a day-to-day basis.
Sure, thank you for having me. Thank you guys. So basically our office deals in New York City multifamily. We own, operate, manage different assets, residential, commercial, everything that goes into it, which I'm sure we're going to be getting into now. It's a family office that was established in 1981, and we continue to grow. We do leasing, commercial, residential, funding, all different types of management. And I'm sure we're going to get more into the specifics as we go on.
Are you specific, is the family office specific to New York and the surrounding area, or do you do anything national?
The majority of it is specific to New York. We've begun in the last few years to look elsewhere, and I'll get into the reasons why, from a number standpoint, but the majority of it is New York City based.
Yeah, and I think we can jump right into that, because I'm sure a lot of people have heard that in discussions, and you'll probably get 1,000 different reasons as to why New York is good or why New York is bad, depending on who you ask and when you ask them. But from what I can see on our side, again, representing hundreds of clients that own real estate here in the city, we have seen, not a majority, but a large amount of them start to reposition part of their portfolio, not the entire amount of the portfolio, outside of New York City. Matt, do you want to kind of share a little bit as to high-level reasons
Sure.
why?
And I think Tony probably will agree with me on this, and I think the break point was really June, July 2019, when the latest Housing and Tenant Protection Act came out. The New York State Legislature really put multifamily, especially owners and operators, behind the 8 ball when dealing with their tenancies, dealing with the economics of the situation, dealing with the legal matters associated with it. The state and the city really did put owners and operators at a significant disadvantage. Many of the aspects of that law really have inhibited increased investment in the affordable, rent-stabilized multifamily stock in New York City. And in my opinion, I think that the biggest aspect of that was the elimination of the vacancy bonus increase associated with rentals. Tony, I don't know if you have any other aspects of that law that really inhibited, if there were any other catalysts that may have led you to looking outside of the New York City 5-borough area, or basically what your assessment was of the change.
I could do an entire podcast on June of 2019. I could talk to you guys for days about what that did to basically the bread and butter of our office. We are, and we still are in many ways, because there are ways around it, but we are value add guys.
Legal ways around it.
Legal ways,
Yes.
Legal ways, which I mean that, by the way.
Yes.
But we're value add guys, right?
Sure.
So that was the, before June of 2019, when you're getting these, offering memorandums, and you're looking at these rent rolls and you're seeing rent stabilized, it's like, the slot machine, noise going off in your head, because you're looking at an opportunity. Obviously, all of that changed afterwards. What I wanted to, and I'm going to circle back to it though, what Michael was saying before, timing really is everything, right? If you're, in any aspect, if you're talking to a lot of these guys that have established themselves in New York City, the majority of them are probably going to tell you that they started their portfolios late 70s, early 80s when there was opportunity. I don't see that opportunity as much in New York now, which is another reason why you're having a lot of people look elsewhere. I don't know what the core reasoning was for these rent laws. I don't want to get political, but you may hear certain people behind the notion that this is for the tenant and it gives the opportunity to actually have affordable rents in New York City. But if you know about rent stabilization and you know the rent stabilization laws, the percentage increases, especially over the last 10 years before they passed that, were so minimal that it really, I mean, it wasn't making that much of a difference. I feel like landlords and property managers and investors in New York City multifamily real estate sort of have, this persona in the eyes of certain people, and maybe there was this notion that the rent laws were going to hurt them or hurt the big guy, but the reality was it didn't. It hurt the little guy, and to your point, a lot of people that had that value add model that were going after those rent stabilized units started looking elsewhere, and at the same time, a lot of those people that were sitting on rent stabilized assets that thought like this is their retirement, and I have plenty of stories I can give you of that. Now we're holding on to something that wasn't worth what it once was.
Yeah, and I have a legacy client who I've been representing for years that, going back to what you said about time and place, in the early 80s, I want to say, maybe mid 80s, he was able to get into some tremendous assets in Brooklyn, whether it was Williamsburg, Bushwick, Dumbo, right, for $1. He would enter into the J51 or 421A program, got in for $1, builder, rehab, and now you have these assets trading for, I can't say how many millions, but trust me, a lot more than $1. Time and place, common sense legislation, and regulation, and I feel like the pendulum has just swung so far to the other way, where, Sock, I know on the institutional side how many PE clients and fund clients that we have that won't even look at a deal that hits their desk in New York City.
In New York generally, there's so much opportunity outside of New York, whether it's in the multifamily space or any other asset class. The less, restrictive regulations that other states offer and other governments. One of the favorites for people keeping up with the news, Florida, right? DeSantis. Come on, come all. We're here to support you. Everyone has their freedoms, and we saw not only a lot of owners and investors, on the institutional side, moving out of state, but even on the tenant side, even on in large part, multifamily tenants. And I'm curious to hear your take on this. How did they deal with, during the pandemic, with all of the, basically they didn't have to pay rent and you couldn't evict them?
Another subject that I could talk to you for hours about. Listen, and
the debt service was still due, though. That's the best part.
Moratoriums.
My famous last words, I'll never forget, I had one of these young Marcus brokers calling up our office in February of 2020, sending us an offer sheet on a building that I basically told him, you know what, let's wait and see what happens with the 2020 elections, and then I'll kind of have a better idea, because we still weren't getting over what happened in June of 2019. It was like a 1-2 punch. You had June and then you had the pandemic.
Fair point. Very
right?
fair point.
And what ends up happening, I told him, I said, I want to see if the future is going to be similar. I used the word similar to what we went through in 2008. Never in my wildest dreams thinking we would have something that made 2008 look like a walk in the park.
Yep.
And I think the key, for us at least, was towards the end of the summer or the beginning of the fall of 2020, when we weren't in a quote-unquote lockdown anymore. Things were slowly opening back up, but we were still feeling the effects of the pandemic, and we would continue to for a ways. To Mike's point, any sort of break that I got from my lenders was over at that point. My expenses hadn't changed, but the incomes on the majority of our properties were now probably 50% lower than they were in February. So you're not even talking a full year, you're talking maybe 6 months, and we had 50% lower, because if you had tenants that...
Mixed use, right?
Yeah, and if you had tenants that, and by the way, this is residential only, commercial is a completely different animal with this, but if you had tenants that retained, they were retaining probably for 10 to 15% less, because if they left, you were renting it for 20 to 25% less.
Right.
And as each month passed by and another added on, and to your point, you had certain people that were leaving the city. They didn't have to be working in Manhattan anymore. If they could work from home, they could go back to, wherever home was. And really, the ramifications of that lasted, I'd say up until probably the turn of 21, 22, when I feel like now we're back to where we were from a residential standpoint before the
So
pandemic.
let's bring it full circle, right? Just to summarize, COVID happens, moratorium, right? Then after that, landlord-tenant courts are closed. You can't get any of these non-paying tenants out. You have property tax increases up the wazoo, 15, 16%, whatever it is. And now we have, 50,000 units that have been artificially pulled off the market, right? Which again, messes with the rents. Nobody has a clear indication of what a one-bedroom on the east side actually costs. Where do we see the rent-stabilized asset class going long-term in New York?
I was going to ask all three of you that question because I wanted your legal advice.
So this is what I think, and I'd be interested to hear it. We have not discussed this, so again, these are fluid thoughts. 50,000 units, right? It might be 60, it might be 45, whatever, around that number. I toured a beautiful 1930s rent-stabilized building in Astoria, Queens, a couple weeks ago. It had that old world charm. You could tell it was built very well. The bricks, the bones were good. If I told you what the inside, the common areas, and then also parts of the exterior looked like just due to neglect. Because again, if you're that small landlord, forget about the big landlords, a small landlord, and this is maybe one of two of your assets, who has $50,000 for capital improvements? Generally, but then who has $50,000 for capital improvements if there's not going to be any value at the end of doing it?
You can't get it back by increasing the rents.
Right, exactly.
And I think what this ties into as well is the impact of COVID, but also going back to that 2019 rent law, where the legislature didn't do tenants any benefit. They did them an incredible disservice in the sense of they limited, number one, totally the vacancy increases. So that meant when a unit becomes vacant, a landlord is going to find every way that they can to save money on any of the repairs or we call them flipping it around, basically painting, plastering, making the unit rentable for the next tenant that comes in. You can't expend as many resources or dollars that you would in making that apartment better, because you're limited on what you can get in the rental on the backside of that. Moreover, they also limited the individual apartment increases, which is a rubric under the rent stabilization laws where every dollar a landlord puts into their unit in an improvement, they can get out X amount in a rental increase.
I think it was 1/40th, I believe it was,
Right.
right? Yeah, and now they limited it to a fixed number, which
Correct.
I've erased from my memory at this point. It
You
was
can
so
only
laughable.
put in over 15 years, $15,000 worth of improvement into an apartment, and all you get back is $1 for $1. So you don't get any profit on that investment into that
So
unit.
it's a static number, it doesn't account for inflation, it doesn't account for anything.
Nothing. It is a static $15,000 number over 15 years.
That's
We are talking,
smart policy, right?
and there's no incentive for a landlord to go in and say, I'm going to make these units incredible, I'm going to get good rents, I'm going to make it a great home for a family, for a person. There's no incentive for that.
Now-
Outside of keeping them outside of jail or getting hit with fines and penalties,
Yes.
right?
Correct.
To Mike's point now, if you are an owner with a large portfolio and you can rob from Peter to pay Paul, so to speak, maybe there's still ways around that.
Sure.
But if you are the owner in Astoria, in the Bronx, in Brooklyn, in the outer boroughs, where this one rent stabilized property is your property, you're dead.
You might live there as well.
You're dead. And many of them do. You know, I'll tell you a quick story. In April of 2019, we were in contract for a 16-unit, fully rent-stabilized building in the East Village. There's a large Ukrainian population in the East Village, and this was a Ukrainian woman. The building was her pride her entire life. She passed away, had no kids, left it to her nieces.
Okay.
So we had huge plans for this building, and at the time, at least from the ownership side of things, the laws that came about in June of 2019 were not, concrete, so to speak, okay? for whatever reason, and you hear this a lot, the sisters, you know, who have nothing to do with real estate, they inherit this property, they start fighting over numbers, they pull out of the deal. June of 2019 happens. July, they come back to us. No, thank you.
Yep.
You know,
See
the
you
building
later.
is not. We don't. But again, here's a spot where the landlord makes out great, and now the property that this, you know, immigrant had her entire life that she was passing down as like her 401k to her
Yep.
nieces is now. I mean, I'm sure they got rid of it eventually, but they got rid of it for what? You know, 60
less,
cents,
yeah.
60 cents on the dollar.
Did you a big favor though?
It was, yeah. Sometimes it's the deals you don't make, right?
Yeah, always.
I was
yeah.
hearing in June of 2019 that there were numerous potential buyers just leaving deposits on the table, which I'm sure we can attest is unheard of. There is always litigation that takes place. There is always some reason or hook that you look for in a contract to get that deposit back. These laws were so onerous and changed the underwriting, like we spoke about before, changed the entire underwriting and financials of an investment on a building in one fell swoop, and people were leaving hundreds of thousands of dollars on the table and walking away because they knew they would lose 10 times that amount buying the building at the contract price that they were in. So they just lost the money, walked away, and counted themselves lucky that they didn't close the deal a week before that law went into place. It really is crazy to think about how much of a devaluation took place and the change in the market itself. And Tony, as you were saying, the underwriting used to be, you would go into a rent stabilized property, you'd look at the rent roll, and if you saw low rents, you said, okay, this is an opportunity.
Meat on the bone there.
That's it. I can value add, I can get these rents up, I can make this apartment beautiful.
Cash out, refi, go to the next one, right?
That's it. That's how I learned.
Yeah.
That's how I was taught.
Yeah.
And you were getting those deals at a 3 cap.
Yeah.
2019, 2020, you started seeing 4, 5. You know, they were moving up. But I'm not trying to flip it around. I'm asking the attorneys here.
So here,
where is this going?
So
now?
here's what I think.
Yeah.
And you can add to this,
Sure.
right? 50,000 units pulled off the market. We have city council that's talking about legalizing basement apartments, right? So clearly, there's a drunk sailor steering the ship here. Where do I see this going? Property owners, management companies this is their form of cumulative protest. And they will have to force, just by nature of their actions, city council's hands to incentivize them to fix these properties, whether it's through J51, 421A programs, tax breaks, credits, etc. Because the masses, the ownership has spoken. And yes, Zach.
I was gonna say, 421A is gone.
Yeah.
So, like, whether you're a multifamily owner or a developer of these types of
What's the incentive?
properties, exactly. So, I agree with everything all three of you said. Frankly, I don't know how someone in their right mind is buying into a multifamily property right now. However, beauty is in the eye of the beholder.
Yeah.
You do hear relatively recently of institutional owners buying up portfolios of multifamilies in Brooklyn specifically.
Yeah.
I don't see.
They're buying vacant ones. They're buying vacant ones because the look-back period on the 2019 Act is 6 years, and there could be potentially personal liability on that. So again, it's a cost risk benefit, right? And if I was a buyer or a fund or family office, I'm not touching rent stabilized from an acquisition perspective right now unless it's vacant.
So, to your question on like what the attorneys think on about like where we're going moving forward, it's not currently multifamily, but office properties, huge distress right now. There's so many vacancies throughout the city. Throughout the country, of course. It's difficult to find tenants, and with so much of the New York City real estate market comprised of office buildings, you can only let them remain vacant for so long. So the idea of conversions has been a hot
Floated.
topic,
Yeah.
recently. But to your point, Michael, about how the city council needs to provide incentives, it's the lack of the incentives that is, kind of prohibiting these developers from actually pursuing those. Although there are some office to residential, rentals, conversions happening here in downtown Manhattan, especially.
Yeah.
You'd expect that to be a lot more happening, but the lack of the incentives has prevented that, unfortunately.
What I would say in my vision, I agree with you about Manhattan 100%. It's going to be the office to residential conversion. It's going to be big for
The boroughs.
particularly that borough. The outer boroughs, I have a little bit of a different outlook. Kind of thinking about things long term. In about 15 to 20 years, New York City rent stabilized properties in the outer boroughs will be back in the position that they were in the late 70s and early 80s, where the city will be giving away deeds to properties for $1. And here's why.
What's the predecessor to that, though?
So-
Burning everything down.
Chaos.
Yes.
Unfortunately.
So basically, and my wife's family's been in multifamily owner operator for many, many years, about 100 years or so, and they got many of their buildings at that time period, late 70s, early 80s, for nothing, for the city, for going into abandoned properties, taking them over and running them. Because what was happening was the tax burden became so onerous, the inflation was so high, the amount of interest you were paying on your debt and your loans on the buildings were in the 11, 12, 13% range. And we can't make repairs economically to any of these units. So the housing stock quality is going to drop precipitously. That's going to lead to two things. That's going to lead to owner-operators not being able to service the debt on their property, to pay the taxes on their property, and there's going to be foreclosures. The worst thing that the city does is manage property. Ask anybody who lives in a NYCHA building, that's the New York City Housing Authority. Those are publicly run housing projects. They are some of the worst conditioned housing stock in the entire city. That's what's going to happen throughout. And you're going to have abandoned properties, you're going to have rundown properties, you're going to have condemned properties that the city is going to have no idea what to do with. And they're going to turn to experienced operators, they're going to turn to experienced property managers, experienced contractors, and they're going to be begging them to take these assets off their hands. So I think in 15 years, that's where we'll be. I think we're at the beginning of the steep decline right
It's
now.
getting bad.
And eventually, it will be an opportunity, but
So for
15
someone-
years.
Like that currently owns a portfolio of multifamily properties, what do you do between now and the 15-year mark?
So what I would say is,
Reposition, get out of Dodge.
if you have assets that are currently cash flowing and have low loan to value on them, you hold and you stay pat. You collect your rents, you have good legal procedures in place, you have good operating standards, you hold pat, you make your cash flow, you try to pay down your debt a little bit over your 5-year cycles, your refi's a little bit lower so you're not paying as much to service your debt, and then when the market starts to turn, in my mind, maybe 15 years, you get into some really exciting properties at dirt cheap level. For those properties that you have a higher loan to value on, you look to reposition. And one of the locations that I've noticed a lot of our clients going to, and a lot of owner operators and investors are looking for those tri-state area locations, meaning New Jersey and Connecticut, right around New York, within a drive's distance of wherever your management office may be, where you can still operate that, get that management fee, and be able to oversee your asset. But you're in a much friendlier location for business, you're in a friendlier location for taxes, you're in a friendlier location for regulation. You're able to up your rents based on what you're willing to put into them, and you can actually make a living, make a profit, and provide people excellent homes at the same time.
And no stabilization.
No stabilization, no rent regulation, still is some rent control floating around out there. So in my mind, right now, if you have an underperforming asset in New York City, you're looking to utilize a very, very important legal procedure for a lot of owner-operators, which is the IRS Section 1031 tax-free exchange. You're able to save a lot of money on your income taxes for whatever entity you would be owning the property in. You take it out of this unfriendly location, transfer it into a friendly location, hopefully run it beautifully, and then 15 years, 20 years down the road, you can make the determination whether you want to take that 1031 again and go back into the New York City market. That's your core location.
Yeah.
Very well said, Matt. Very well said. You sound like someone who's married to a person in multifamily. Two things I want to say. One, I'll just get out of the way. You mentioned NYCHA. Did any of you see today there was an article out on how the amount of arrears that are owed to NYCHA right now from all of these New York City housing properties you were talking
No, I
about?
didn't see that.
$500 million. $500 million. That's number one. Number two,
city doesn't have money.
I agree with everything you said. The one thing that I want to point out, just curious all your thoughts are, if you compare what could happen in the next 15 years to the last time we saw something similar, which we'll call the late 70s, I do think you have a lot more players in the real estate game now in New York that can take the risks on these assets. And that's something that I've seen, from the brokerage side of things. I can't tell you guys the amount of emails that were sent to me over the last year where the headline read, property in the same family for 50 years, for 70 years, for 80 years on the market, right? Yeah. So you had people that, that were scared, right? And like you said, they wanted to get out, but those emails, or those properties, I should say, they were selling.
Yeah.
So who was buying them? So I do think there's a lot of truth to what you said. I just also think that there's maybe a few more guys willing to take risks now on these properties. Maybe they do have the capital to sit on it and say, you know what, let's wait 5, 10, whatever it's going to be, 15 years. Let's see if maybe something happens with these laws, and we can get in at a good price point.
Or they're on day 40 of their 1031 exchange, and they need to identify. And rather
You
than,
see that a lot as well.
Yeah.
You see
Look,
that a lot.
it comes down to underwriting tolerance, right? In my opinion, again, having owned and operated real estate, but also counseled many clients, I don't think real estate should be a risky play, right? Especially multifamily. It makes sense. Here's your P&L. This is your cap rate. This is your net cap, etc. If it gets too risky, go buy equities, go buy cryptocurrency, because the asset class itself, from a totality perspective, it should be relatively safe. That's why during times of hyperinflation, where do a lot of people throw money into, right? Bonds and real estate. So that's just my opinion on it. A lot of people could just be on day 44 of their identification period, but yes.
One thing I've also noticed, which probably wasn't as prevalent back in that last cycle, late 70s, early 80s, international money.
Yeah.
I think international money is a big
100%.
aspect of what, prior to June 2019, was inflating the gross rent multiples up to 15, 16,
100%.
even 17 times rent in the outer boroughs, which was unheard of
Yeah.
previously.
Yeah.
New York, like core Manhattan, I was seeing 20 to 25 gross rent multiple,
Wow.
trading buildings, fully rent stabilized. And even after, as you mentioned, Tony, that there are still people willing to come into the market, I find that in a lot of instances, it is either totally international money that is coming out of a location where they want to get into the United States, have their funds
Safe
in
haven.
Exactly, a safe asset. Like you said, Mike, real estate is a safe bet. The brick and mortar will be there. You will have the demand, especially for residential units, and so they park it. And a lot of that foreign money tends to inflate the market, and that may be one of the things that wasn't present in that previous cycle that will be present in the current one that we do need to account for.
To Mike's point, I mean, the formula that we used, it's simple, right? Do the numbers work or do the numbers not work, right?
Mm-hmm.
And in those years, 13, 14, 15, when the international money was coming in, and we were basically telling, these brokerage offices, here's where the deal makes sense to us.
Mm-hmm.
And they weren't calling us back
Yeah.
because they had the international money coming in that was paying, an extra however many million it was, and they were selling it. It was a ridiculous time. It also inflated commercial rents in terms of retail, at least the way I saw it.
Mm-hmm.
And that, to me, is actually the one thing from the ownership side that has not bounced back from the pandemic. Our residential rents have bounced back. You can make the argument that before the pandemic, the commercial rents in the city were a balloon anyway, and they were going to pop at some point. That's a whole different conversation. But yeah, the international money was a huge play.
Right.
So on that point, discuss take interest, right? Repositioning your assets into other places. Let's kind of jump into joint ventures on acquisitions. What's your thoughts on that, Tony?
What do you mean specifically in terms of?
So hypothetically, you're looking to sell an asset in New York. Maybe you're going to trade up into a bigger asset, say in the Midwest, and it's a little bit too big for you. But you come to me and you say, Michael, I like you. Let's go into partnership together on this. My entity, your entity. We're selling our respective properties. We're going to come together. Any experience in that?
So you and I were speaking earlier, and I was kind of giving you the whole history of our office, so to speak. We will join with someone in terms of managing their asset and sort of, you know, being an advisor for their asset, you know, given the experience in real estate that we have. Rarely do we team up in terms of, you know, investing our money with somebody else towards an asset. That's just us. It's something that, you know, in the past, once or twice we may have done, for whatever reason it hasn't worked out. I see it all the time, but me personally, and we're very, you know, old school. Every penny that comes into a building and every penny that goes out, I monitor, right? So there's a very old school mentality to the way that we run our office, and once you go about, you know, managing an asset in a way that you're not familiar with, to me it's dangerous. But again, that's just me. That's not me saying that I wouldn't do it in the future, because times are changing. Like we said, I hadn't looked at anything out of state until probably 3-4 years ago, right? And now I'm, you know, I spoke to you earlier about it. I'm approached by people all the time. So if it goes back to what I said earlier. If the numbers work, the numbers work. But changing the way you manage an asset, at least for me, it's almost like starting all over. You know, does that make sense?
It makes perfect sense.
Hey, let me ask you a question, a little bit off topic.
Yeah,
You
yeah.
said that you have old school family office.
Oh yeah.
Is there an origin story? I know my wife's family office started, her great-grandfather, butcher, came over from Russia, had his storefront on the bottom level, rented above. His wife, either wanted to paint or renovate or something like that. The landlord didn't want to do it. Said, I'll buy it out, fine. 5 or 6 years later, she wasn't happy with the apartment, whatever it was. She wanted to move. Okay, fine, but I don't want to deal with the landlord. He's bought another building, ended up saving up, you know, doing well, and that was kind of it. His wife wanted to move and renovate, and instead of having to deal with landlords with it, he said, all right, fine, but I want to own it.
Yeah.
Is there a family origin story?
There's always an origin story. So I mean, how can I say this? You know, if he hears this, I have to be careful. So my father immigrated, just not to mess it up, but my father immigrated to this country in the 70s, and like a lot of Greek immigrants at the time, restaurant, food. I'm the only Greek who's probably never worked in the restaurant industry that you'll meet. So basically, one job led to another, and we go back to the late 70s, early 80s. There was a time where, you know, Manhattan real estate was very, very risky, as I'm sure you guys know. And back to partnerships, he and his brother were running a gas station. The gas station was doing very well, had a lot of cash, wanted to put the cash into real estate, came across a building on 59th Street in Manhattan, right by the bridge. Risky play, took a risk. The next thing you know, here we are all these years later. Yeah.
So it's not all bad news, though, right? Real estate in New York is always going to be real estate in New York. I think some positive news, specifically coming out of the landlord-tenant litigation space, is we've seen the courts open up. We see cases are now, the dockets are moving, cases are being prosecuted, and the law firms and the lawyers who know how to push cases are pushing them. Matt, I know we just launched our L&T practice group a couple months ago, and what have you seen from, again, moratorium, COVID to now?
Sure. Sure.
It's been night and day, though, in my opinion.
Yeah, a little bit of background in addition to my transactional work. I'm also a landlord-tenant litigator for about 8 years or so. Been in mainly Bronx housing courts, where a lot of clients' core assets are, and up until February 2020, everything was rolling along. Even though you had the rent law hit coming in, at least the courts were open. You can get your rent when it was due. You didn't have to jump through a million hoops. It wasn't paperwork intensive. Yes, you were there every day on the ground, working the cases, doing the stipulations, but the money was coming in, tenants were working, people were open, and things were running as they were intended to run. And then February 2020 hit, March 7th. March 7th, 2020, state of emergency, all the courts closed. I was there that day. They had herded us all out of the courthouse, basically said, we're closed, we'll let you know when we're back open.
Yeah.
And it wasn't for a full 2 years, 22 months.
What was the
15th,
day?
2022.
22.
January 15th, 2022.
January 15th,
The eviction moratorium, quote unquote, was lifted. The ERAP program.
Now we're getting
was in effect.
possessory judgments every day.
Now we're back in court relatively, and even for the first few months of 2020, even after the moratorium was lifted, state of emergency was pulled back, the courts were still very hesitant to actually adjudicate cases. They didn't want things going forward, and I think the reason is that they didn't want to be the judge in the press who was the first one to sign an eviction warrant, to sign a possessory judgment, to have an eviction taking place, because the climate was very, very pro cancel rent, very pro let us live free. I mean, it was a big.
But I think judges now have said enough's enough.
Well,
yes.
Did you see that for residential and commercial, or was it one or the other? And there's a reason I asked.
So I mainly saw them being very unwilling to go forward, even for the first couple months after December 2022 in residential. Residential is one of the locations because you're dealing with someone's home. And that's always the consideration, is this is where someone and their family live. So I understand that the judges are a little bit more reticent in that situation. Commercial, state of emergency lifted, courts open back up, they kind of got rolling on that sense. There's still some of the questions about de Blasio's December 2020 executive action, where he basically eliminated personal guarantees on many of the
city council.
Commercial leases.
On many of the commercial leases.
And that's a big thing we've litigated over the past couple of years.
Since been
on both sides of the coin.
Numerous pieces of litigation involving that, from tenants, from landlords, whatever it is. But on the residential side, for a couple months after, they still didn't want to get back to normal. And I've noticed, I've been in court the last couple months, things are really starting to roll. Not nearly as much as they were pre-COVID, but it is moving. We are getting cases in front of judges. We are, conferencing cases, getting stipulations entered into, getting warrants, issued, getting warrants served. And the one thing that has been at least a positive out of all of this was that there are some programs in place, and there are pros and cons to some of these programs. The ERAP program has been something that has been beneficial for landlords. I know for a lot of our clients it's been something that's been beneficial. The LRAP program to a lesser extent, but did have somewhat of a beneficial impact. And there are some cons to it. There are people who in any situation will abuse the system and attempt to kind of get around how it was intended to be used, whether they're making multiple applications after receiving funds, or whether they're being denied because of their income levels, still making applications. And the reason for that is there's an automatic administrative stay that goes into place on any landlord-tenant case when an ERAP application is submitted. But seeing it few and far between, and in a lot of instances, in the cases that we're getting in front of judges, the cases that we are starting, we are seeing them getting on the schedule that they were pre-COVID, where within a month you can get into court, you can get in front of a judge, and within 3 to 4 months you can either get all your money or you can get an eviction taking place and enforce on your judgment.
ERAP, I use the term, it's like a lifesaver, right? And that's really, I can't tell you the amount. Now, I told you guys earlier, we're very hands-on with every penny coming in and out. Same thing with management.
Sure.
The amount of residential tenants that fell behind, whether due to COVID or for other reasons, that I was calling and saying, listen, the state is giving you a lifesaver.
Yeah.
Here's the link, apply. I'm gonna do everything on my end. And for the most part, from the residential side, it worked. What I was nervous about, and it's interesting, I'm curious how you guys saw it, was once the courts opened back up with the commercial cases that didn't work with us. And what I mean by that is every retail, commercial, whether it's a restaurant, a 99-cent store, nail salon, whatever, everybody was affected, right? I mean, you're closed for 3-4 months, you can't make money. I would say 90% of those tenants, small businesses, we were able to work out agreements with. We self-litigated, right, so to speak. We waived whatever we could waive.
Out-of-court workouts.
Correct. We waived whatever we could. It was a unique time. We've never been through it before.
I called it creative lawyering, because and the lawyers who could think outside of the box, they did their clients a tremendous service. And the ones who said, this is the way we've always done it, this is whatever, throw that out the window, because these are unprecedented times.
Correct.
That was a large part of our expansion in 2021, because we were dealing with those types of matters day in and day out.
Small business clients,
100%. Whether it was restaurants, like you said, or it could be a standard mom and pop shop. we fought for them outside of court, thankfully. They were closed at the time, but even, you know, if you waited until they opened, we would have lost out on the opportunities that we created for them.
Yeah, and between the personal guarantee waiver, between debt service still being due for the landlord, it was just these cumulative circumstances that forced the parties to the table. And it was up to the lawyers to really hammer out a deal and make not everybody was gonna feel, you know, peachy and keen and good about the situation, but that's never a good deal.
Right.
If you go to a table and you get everything that you want and you're happy and you got 10 out of 10, you rob the other guy, because that's not how a good deal should be. It should be, right,
Mutually beneficial.
I'll tell you,
beneficial.
commercial landlords seem to be a lot more willing to entertain, you know, relief requests from tenants than commercial lenders were to commercial borrowers.
Well, yes, I mean, because they didn't have to, right, for the most part.
I mean, you never really, none of them had to, right? The landlords didn't have to cooperate, but I guess the lenders being in the position of power that they were in.
It was unprecedented times for everybody, for the tenants, for the owners, and for the lenders. And I think that ultimately that's why you wanted to come to an agreement. But what I noticed is, you know, whether it was being on the phone with these people, helping them apply for their PPP loans, coming to these agreements where you're waiving rent due, you're deferring the rest of the rent.
Yeah.
You gave them the opportunity to stay in business and to work something out, and all of them are still here today. The ones that you couldn't come to that agreement with, those were the ones I was nervous about once we got back to a landlord-tenant court, because I'm thinking that the judges are going to give them the same sort of treatment that they're giving the residential tenants. And I was pleased to find out that that wasn't the case, because I think what a lot of smart judges realized was, like I just said, if you were going through hard times due to the pandemic with your owner, and you're a good tenant,
Yep.
you figured something out with your owner.
Yep.
And if you're still in court, now that the courts are open, you were probably having some sort of an issue pre-pandemic anyway.
Trying to take advantage of
And I was pleased to find that out. I'm curious if that's something that you guys noticed too.
Yes.
Yeah.
Yes.
Yeah,
yeah.
Definitely,
for sure.
Yeah.
definitely.
100%. And, you know, I think it goes back to the fact that it's a totally different type of tenancy at that point. You're dealing with somebody who's a businessman in a commercial space, working, you know, to make an economic profit on, you know, whatever their industry might be, and the judge says to themselves, well, they didn't work out anything ahead of time, they haven't paid rent, you know, whatsoever, even after they were fully operational. It's not a situation where you're looking to pay rent for a period of time that you're totally closed. What's going on here? What's the situation? Why are we still have arrears growing even though you've been fully operational for more than a year at this point in time?
tenants being pigs.
Right.
Well, why don't I tie everything that we've discussed into one story that I'm actually going through right now? I got a rent-stabilized tenant who's fallen behind almost 18 months on rent.
Okay.
Who knows why? We just today, December 1st, had her in court to start the non-payment, and what did she do 2 weeks ago? She applied for ERAP. I don't even know if they're still funding the program. I'm being sincere. They are? Okay, so maybe we'll get paid. Fine. But what did her applying for ERAP do? It basically stopped the case.
Yes.
You know, so
Yes.
why couldn't she apply 2 months ago? Why couldn't she apply this? So, you know,
Yeah.
it's, teach them.
Yeah. And, you know, you have those situations that are arising. One thing that is beneficial, at least on the ERAP front, in the legal sense of things, is there have been several court decisions that have come out recently. I know that RSA, the Rent Stabilization Association in the city of New York, has kind of published those and made them more widely known. And there are judges who have been vacating the administrative stays in the situation where there may be either an abuse of the ERAP program, where I spoke about earlier, where there's multiple instances of application, even though the amount owed is significantly more than what can be provided, even if the person has applied previously, been denied, applied previously and received funds, whatever the situation may be, or if there is a case that was brought in front of the court that isn't about money. Let's say that you have a tenant who's incredibly destructive to the property, an incredible nuisance to the other tenants who reside in the building. They've been attempting to apply for ERAP and utilize the administrative stay in those type of matters, and there have been several judges who have ruled that no, even though you may owe rent, this case is not about rent, and the ERAP stay was not intended to protect you from putting holes in all of the hallway walls until they make a determination. It was if you've fallen on hard times because of the pandemic or whatever reason, we have this available to you. And I've even seen judges in cases that are dealing with, you know, rent specifically, if that ERAP receipt from the city to the tenant wouldn't come close to fully satisfying the amount of arrears, there's even a possibility of vacating that stay in some circumstances.
I think a lot of it starts with education, having the proper representation, and again, these aren't just buzzwords, I really do mean it. Aggressive lawyering, creative lawyering, working together with the client, with the property owner working together with the tenant, and trying to reach some kind of resolution here, because at the end of the day, what we all kind of forget is everyone is still a person, right? And what was missing over the last couple of years was the breakdown in communication. And I think once parties started communicating, we saw more deals getting
It's the only way.
wrapped up. So, Tony, what's the future for TZM? Do you anticipate expansion? Are you taking third-party clients on?
So we are taking third-party clients on in terms of management. It's a family business. So like I told you, my brother's come along the last few years. He's opened up a brokerage for us. So we're doing, third-party brokerage as well, and in addition to, our own leasing. We tiptoed around it a little bit. You and I spoke about it earlier. I believe in New York. I do. I'm hoping it's not going to take another 15 years, but I think there's going to be an opportunity. I don't know how the guy that has one property, could have made it through the pandemic or can start now. But I do believe that there's going to be another time, unique time, and right time to get back into multifamily here. But at the same time, I'm a numbers guy.
Yeah.
And if the numbers work, even if it's out of state, you're still playing the same game. You're just playing a bit in a different league.
Yeah.
That's all. And it's learning that area, just like we know the area here.
Yeah.
And with closing, heading into unprecedented times, cash is king, right? Don't buy with hopes of appreciation. Stick to the metrics, to the formula that's tried and true, irrespective of where you are, and everything's going to be okay. So I am bullish on New York as well, not because we're all born and raised here, but just because it's the best place in the world. It really is. So that's it from us here at KI Legal. Thank you so much for joining. Tony, thank you so much for coming on. How can people reach out to you?
So thank you for having me, and thank you guys for, you have a beautiful office here. I wish you guys continued success and continued growth. So we have a website, tzmrealty.com. It's got all the information on everything that we offer. Our contact information's there. Check it out, and I'm available at any time. But I really thank you guys for having me, and I enjoyed the conversation.
Thanks so much for coming in.
Until next time, we're signing off. Thanks.
Take care.